So with that, I want to go to another slide where I want to comment a little bit about something that actually comes up quite often when we're originating new loans, in particular purchase loans. And I saw this article online on the financial news page, and I wanted to go over it because the article I thought was kind of interesting, and as I anticipated, was making a suggestion about, when the time you're closing, and in that regard, it was sort of, making that claim based on certain assumptions that I think are somewhat faulty. Now, the article I'm referring to is, you can see the headline of the article there. I'm a real estate agent. Don't close escrow at this time of the month. It was in Go Banking Rates on Tuesday, March 26. You can see there the name of the writer. And when I saw that headline, I chuckled to myself because I thought, this suggestion, I think, is probably, like I said, a little bit faulty. The basic premise of the article was that closing at the end of the month is going to save you money. And of course, I put a question mark on that first bullet point, because really, is that really true? Is it going to actually cost you less on a mortgage if you wait and close at the end of the month? Well, let's explore that. The further premise of this is the writer is suggesting that you should close at the end of the month, because if you close earlier, or basically any time in the end of the month or any time during the month, there is going to be a proration done for property taxes, for homeowners insurance, and for prepaid interest when you're getting a mortgage for the transaction. So the overall suggestion is, by closing at the end of the month, the amount of those prorated expenses is going to be less, and therefore you're going to save money. Now, I'm going to challenge that a little bit here in these further bullet points in my comments. First, understand something that's pretty important when it comes to getting a mortgage on a home purchase. When you get that mortgage, your first mortgage payment is going to be due 30 days after the first of the month following the month you close. Let me repeat that. When getting a mortgage on a purchase transaction, the first mortgage payment will be due 30 days after the first of the month following the month that you close. The basic idea is your first mortgage payment, when due, is supposed to cover at least a 30-day period of time. So, for example, we're in March. If we close a loan in March, the first payment date isn't going to be April 1st. It's going to be May 1st. Why? That May 1st payment pays the interest in arrears on the mortgage. So that May 1st payment covers the interest due on the mortgage from April 1 to May 1. So obviously, if you close at the end of the month, you won't have a whole lot of proration done on the mortgage that's closing, because your first mortgage payment, if it's due May 1, covering April 1 to May 1, and let's say you're closing today, March 28th, you're only going to have about 4 days of prepaid interest that isn't accounted for when you make that May 1 payment. Now, and occasionally you can have a situation where you might close the first couple of days of the month, like let's say you close next week on April 2nd or 3rd. You can still have a May 1 payment. When that happens, you actually get a credit of prorated interest, because your May 1 payment is paying for a full 30-day period, April 1 to May 1. But if you don't close until April 5th, then that May 1 mortgage payment is paying too much interest, so they give you a credit for that 5 days at the closing of the transaction. There was a particular sentence in this article that really got my attention, and as I put below the bullet point I'm going to read to you, I declared that it was an untrue and somewhat nonsensical statement. So let me read it to you. If you close on a home on the 5th of the month, more than likely, your first actual mortgage payment would not be due until the first day of the following month. Well, right there, that's not quite accurate. Maybe the writer just made a mistake in editing that sentence or creating that sentence. If you close on a home on the 5th of the month, more than likely your first actual mortgage payment would not be due until the first of the following month. That's not true, as I explained earlier. If you were closing a mortgage on March 5th, your first mortgage payment is not the first of the following month. It's not April 1st. It's still May 1st, which is essentially 56 days away. Now, the rest of this sentence goes on to say, so you have to pay the interest up front for that entire period that you were not even living there yet. Well, I call that nonsensical. And the reason I do is if you're going to close, particularly a purchase transaction on March 5th, and you're going to prepay interest for basically 26 days from March 5th up to April 1, yeah, that's more expensive closing. But remember that your first payment isn't for 56 days after the closing date. So, and the idea that if you close on March 5th, that you're going to be paying all that prepaid interest for 26 days without having the benefit of moving into the home, well, I would argue that almost never happens. Now, it's true, somebody buying a home that they're going to live in, when they close escrow, they may not move into it right away. Maybe they want to do some minor enhancements to the property. Maybe they want to repaint it. Maybe they want to do some other minor work to it to prepare to move into it. So in that respect, yeah, you may not live in it right away, but this article, I think, misses a more fundamental point. When you close early, yeah, you're paying more for these prorated expenses, but you're getting possession of the property at that earlier date, allowing you either, number one, to move into it right away and not have a first mortgage payment for almost 2 months. Or, yeah, maybe you're not going to move into it right away, but you still get possession of the property after March 5th in this example. So if there is some minor enhancements you want to do to the property, you can get access to the property and actually get it done. I would argue in either one of those scenarios that prorated, higher expense for, proration of taxes, insurance, and in particular interest is well worth it. And as I put in the second to last bullet point, early month closing does mean more prorated expense, but it also means your first payment may be close to 60 days away. So is there a really net cost savings? I would argue no. When you close earlier, yes, more prorated expenses, but you get possession of the home sooner and your first mortgage payment is pushed much farther out, almost 2 months. I would argue, yes, there is a cash flow benefit to your household closing late in the month. But on the other hand, if you close early in the month, getting possession, I think, compensates for or offsets that additional prorated expense so that in reality, you're not really saving any money net. And of course, to conclude with that my analysis, I would say, have you ever heard of 6 of one, half dozen of the other? That's the way I would portray or characterize this concept. I tell my customers all the time, yeah, you can close end of the month, and yeah, you'll have less prepaid expenses, but your first payment's a lot sooner. So keep that in mind, because that first payment coming a lot sooner may actually prove to be a bigger burden for you than just closing early and paying those prorated expenses. So anyway, that's my conclusion on that. Just wanted to share that with you. I think this article is a little bit misdirected and misguided in terms of the advice it's giving.